Hello, very good morning to all, and welcome to a brand new week ahead. I'm Kelvin here again. I hope that you all have a great weekend, prior weekend before, and getting refreshed for this brand new week. So, very good morning. Today will be Monday, the 20th of May, 2024. So, before we jump straight into our daily dose of market insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. Pardon me. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into that usual short-term technical outlook for today on the broad-based cross assets, that means i.e. the major stock indices, the major dollar pair, two key commodities, gold, XAU/USD, and as well as West Texas crude oil. Let's have a recap of what happened overnight, that means i.e. over on Friday, and as well as any key data or events that has occurred during the weekend and today's Asian session. And as well, I talk a bit, I will actually dissect a bit about the medium-term intermarket correlation that is taking place right now across the broad-based cross-asset classes. Okay, so let us start with news and events as well as economic data that occur on last Friday. So on last Friday, what we have over here is that we do have a slew of Chinese data. Let me share with you on my screen over here, which is the China industrial production data, retail sales, and as well as unemployment rate. So what you could see over here is we rather have a mixed flow of data. Why do I say mixed? If you look at industrial production, is rather strong on the Chinese side of the story. That means for the month of April, industrial production actually rose beyond expectation, 6.7% year on year, versus expectation of only 5.5%, and as well as surpassed the previous month of March of 6.7%. So if you look at the clear trend over here, all right, it's actually expanding on the upside for industrial production. If you go on the 5-year basis, you start to see a series of higher low. Okay, so very clearly it's a nice gentle uptrend for industrial production, spearheaded by the China top policymakers in their high-tech industry. Okay, that is that ongoing US tech rivalry, where China top policymaker is earmarking more funds to dedicated higher tech, we call it sectors, that actually explain the rise in the Chinese industrial production on a year-on-year basis for April. But however, if you look at that domestic demand over here, the domestic inter-demand still remains lackluster as retail sales continue to decline on a year-on-year basis for April. Not decline, continue the pace of increase, I would say, soften. Okay, not decline, the pace of increase softened on a year-on-year basis in April, 2.3% only versus expectation of 3.8% and below the prior month of March of 3.1%. So if you look at the trend over here, okay, it continues to be rather lackluster, all right, in terms of their pace of growth for retail sales in China. So if you look at the 5-year basis as well, it's actually showing lower high instead. All right, still in positive territory, but the pace of expansion has indeed slowed down in the month of April. So that actually telling us that the consumer or the internal demand in China is still facing a lack of confidence to actually spend more. All right, despite the fact that this month, the Chinese top policymaker continue to actually do piecemeal easing measure only. Okay, and one of the primary reason, the lack of confidence in consumer spending, or i.e. retail sales, or we can say the lack of we call it consumers of opening their wallets to spend further in China, that is driving this lackluster internal demand expansion in China, is due to a wealth effect from the property market. So if you look at the property market, the housing prices continue to actually decelerate on the downside on a year-on-year basis for the month of April, negative 3.1% for the month of April versus negative 2% year-on-year for the prior month of March. So if you look at the trend over here of the housing price, is clearly showing an accelerated pace of deceleration. So if you look at the 10-year price, it's in fact April month of negative 3.1%. That's the latest figure. Is the lowest figure that is being seen so far in July 2015. That's close to about what? Close to about 9 years. All right. So as we know that housing prices make out the housing market make out a significant portion of the wealth in China. China's citizens. So that actually explains the negative wealth effect on their internal demand. That means lower housing prices will lead to lower spending. We call it propensity for the Chinese consumer. So that should explain the continual pace of that slowdown in the pace of expansion in retail sales, despite the fact that the Chinese authorities or top policymakers doing piecemeal stimulus measure. So what it means over here is that in order to reverse this trend of slowing pace of China retail spending or to improve China internal demand, it got to actually address the slowing, the ongoing pace of deceleration in these housing prices in China. So that's why on last Friday, the China's top policymaker attempt to actually end this property crisis by announcing another so-called piecemeal basis of broad-based property measures. That means, i.e., the China Central Bank right now is going to actually have a fund of 42 billion to buy out unsold home directly from the property developers. So it's not in trillion, it's still in billion. Because why? Because if you look at some of the economists that measures the total amount of unsold home is go by the trillion. So like I said again, this is more like new measures announcing from top China policymakers, but it's more like a piecemeal basis rather than the all-out liquidity measures that's going to actually address this we call it reverse this pace of deceleration in housing prices. All right, but nevertheless, it actually kickstarted another round of positive feedback loop into the Hang Seng index, which actually rose on last Friday. So later we actually share with you the short-term technical outlook for the Hang Seng index. Okay, so now another news I will share with you over the weekend over here is we do have this geopolitical risk premium who is potentially on the rise again because of there's this Iran issue. All right, so let me highlight to you this Iran issue again. It's actually regarding the there's a helicopter carrying the current president and the foreign minister of Iran that actually crashed on yesterday, and right now their whereabouts are still unknown. All right, that the whereabouts are still unknown. All right, over here. All right, so the key thing over here is that president right now is missing. So there's a lot of ongoing news flow over here is that stating that could be a bit of due to sabotage, or there could be a internal coup that is going on in Iran that causes this issue. But nevertheless, it actually saw oil prices actually rise further in today's Asia session, breaching above the $80 mark per barrel on the West Texas crude oil. So a bit of geopolitical risk premium that is actually at play in Iran right now. And also do not forget over here is that we also do see the further rise in gold on last Friday. And right now during the Asia session, spot gold XAU/USD is actually above the 2040-20 level and now trading at a fresh all-time high on the backdrop of this rising geopolitical risk premium that is due to this kind of a fluid Iran situation right now. Okay, so and also on last Friday, I'll share with you all is very interestingly last day. Let me share the price section on this. Okay, let me highlight to you all again. Where is it? Yes. Okay, so I want to highlight to you all again on last Friday. Very interestingly, we know that the US CPI data on Friday pushed down the US Treasury yield, because i.e. they are looking for a much more potential dovish Fed down the road. But on last Friday, what we could see over here is that the US government 2-year bond starts to actually recover, and where they bounce off the 200-day moving average and the 4.72% key medium-term pivotal support. And last Friday price action on the US 2-year Treasury yield, which is much more in line with the Fed funds rate, because it's a very short-term 2-year year, has almost recovered the losses that is being inflicted by that so-called softer US CPI data. So what you see over here is that the current bond market right now is actually pricing in a potential tighter, potential less dovish US policy, monetary policy, US Federal Reserve monetary policy, after that so-called that Daisy US CPI data that was released on last Friday. And very similarly, we see also on the US 10-year Treasury yield as well. The rebound is not so steep as the 2-year, but it's almost erased off that onslaught that was the black candle. This black candle that was actually inflicted by that softer US CPI data. So like I explained earlier on, as we know that even though the US CPI data is still it released on the softer side of the story, but however, services inflation continues to be on the uptick. That's why the bond prices actually, the bond yield actually realized that, and it managed to actually recover on last Friday for the 10-year and the 2-year. And what's interesting, both of them bounced off from their key medium-term pivotal support at the 200-day moving average, and for the 10-year is at 4.32%. All right. So now, how does it translate to stock prices, stock market? All right. So for the stock market over here is that on last Friday, what we could see is that the US market continued to be pretty resilient. No major sell-off despite the recovery in the 10-year US Treasury yield and the 2-year US Treasury yield, because we know that a push up in the 10-year Treasury yield indicating to us higher cost of funding that could actually potentially cramp down or trim the profit margin of we call it companies that could actually see potential earnings, we call it a slowdown, earnings growth slowdown. But that's not being reflected in the price action of the major US stock indices on last Friday. Rather firm, I would say that on last Friday, they're rather doing a consolidation, minor consolidation instead. If you look at the SPX, it's only up 0.12%. The Nasdaq 100 down negative 0.6%, the Dow Jones Industrial Average up 0.34%, and the Russell 2000 almost unchanged at negative 0.03%. Overall, all in all, last week, the SPX, the Nasdaq, the Dow Jones, and the Russell have a rather fantastic week. The SPX last week gaining a weekly gain of 1.54%, the Nasdaq gaining 2.12%, being the top performer of last week on a weekly gain basis. The Dow Jones Industrial Average added 1.24%, and the Russell 2000 added 1.74%. And what's interesting is that last Friday, outperformance of the Dow Jones Industrial Average managed to saw the Dow Jones Industrial Average breaching another fresh all-time high on last Friday. Okay, another fresh all-time high on last Friday on the Dow Jones Industrial Average. All right, so net overall, what's driving in the US market right now is much more related to two factors rather than macro factors. Okay, macro factors is still not so fantastic. Why? Just now I shared with you all, there could be still a potential rise in long-term treasury yield, both on the 10-year and as well as the short-term 2-year, which could increase the cost of funding in the US. So that has actually been represented by this particular chart here. So this particular chart I see on my screen over here is the red line is economic surprise index, so that represents macro factor. So if this surprise index is going downwards, that means i.e. it actually surprised more on the downsides. That means the actual data point came out more on the downside rather than the upside in terms of analyst or expectation. It will start to just slope downwards. That means telling us that it's a negative macro environment by this City Economic Surprise Index. And based on the latest price action on last Friday, okay, last Friday or last Thursday, I would say, is down negative 21.6 for the Citigroup Economic Surprise Index, indicating to us macro more of a skewed towards more of a macro adverse environment in the US. Okay, that also actually been seen on the push up in the US 10-year Treasury and 2-year Treasury yield as well in terms of funding, and that also take into account of, like I share with your weak consumer sentiment, which I explained earlier in my previous daily dose of market insights for those who are following. So this is actually a snapshot of all the important macro variables in the US economy as compiled by this Citigroup that they compile together. They call it the Citigroup Economic Surprise Index. And this negative 21.6% over here, no, it's a level, not percent, pardon me, negative 21.6 is the lowest level seen in almost 1.5 years. And what's interesting over here, what's diverging, right? If I were to go to a 6-month basis, right, you could see much more clearer, is this yellow bar over here. So this yellow bar is based on 2 Fridays ago. I haven't get the latest data yet out from this provider called Micro. Okay, so they compile this for me. They compile this over here. So by on they can't have the latest. I believe that only towards maybe hopefully in the afternoon session I'll be able to get the latest last Friday data. So this was 2 Friday ago, 10th of May. So the Citigroup earnings revision index is positive at 0.15, and this is the highest positive level since the week of 1st of May. All right. So what it means that this earnings upgrade continue to be on the uptick, forward earnings upgrade, okay, is continuing to be on the uptick in US as compiled by the Citigroup earnings revision index. So what it means that macro factor is not doing well, but micro factor is doing well. Why? Because analysts continues to actually upgrade their earnings estimate for US corporation in terms of a 12-month forward-looking basis. Okay, and also on this particular chart that I shared with you earlier on, will be, let me share, where's this chart? Okay, let me open up again. I think it should be this. Yeah, this is the chart. Okay, so this is the momentum factor. So I could see over here is that the momentum factor continues to actually outperform the quality factor of the SPX 500 index by plotting the ratio of the SPX 500 momentum ETF against the normal S&P 500 ETF. You see the momentum factor of the SPF ETF is actually still holding above the previous breakout, major bullish breakout that has taken shape in early part of this year, still holding above this line, okay, this breakout line, and inching up higher. Whereas the quality factor, the S&P 500 quality factor, that means i.e. They re-rank the stock with the higher weightage according to a lower debt ratio. That's one of them, the quality factor. So the quality factor, S&P 500 quality factor ETF is in fact sloping, is in fact trending downwards. It can't break above this key resistance level by plotting the S&P 500 quality ETF, where it ranked according the component stock by higher quality factors, like a lower debt ratio is one of them, versus the normal S&P 500. That means it's a ratio. So this ratio can't break above the major trendline resistance and continue to actually still inching downwards compared to the momentum factor ratio against the normal S&P 500. It continues to actually inch upwards after a retest on that previous major breakout level over here, the breakout line. The previous resistance breakout now turns into a pullback support. Okay, so what you see over here is that the current positive price action on the S&P 500 is not driven by macro factor. It's more driven by micro factor, which I share with you is the continuous of that earnings revision upgrade, and as well as momentum factor by the outperformance of the S&P 500 momentum ETF against the normal S&P 500. Okay, so that's the current intermarket correlation play that is actually at play right now. Okay, and also on last Friday, like I shared with you, dollar index continue to trade sideways. There is no clear momentum coming into the dollar strength story. So if you look at the dollar strength picture by plotting, pardon me, by Give me again on the dollar index. Where's the dollar index? Yeah, over here. Yes, over here. So this is the 5-day rolling performance of the dollar against the major currency. All right. Of now, seems to be a sideways range configuration. Okay. After that, we call it that sell off earlier on the exposed CPI, US CPI data. Then thereafter, it started to rate sideways. Okay, based on the 5-day range performance. So it's more of a sideways range bound configuration so far on the US, we call it the FX market among the major dollar pair. So I want to highlight again over here is currently due to this ongoing, we call it positive momentum factor that is at play, and as well as micro factor as play, it seems to us that at this point in time, okay, where is it? Okay, let me share with the price. Yeah, so this is the 3-month rolling performance of the major stock indices globally. I plotted against the dollar index. So the dollar index is going sideways 3 months as well. But however, the top performer right now is actually not the major US stock indices anymore. It's actually the rest of the world according to their domestic currency, plotted according to their domestic currency. That means the Hang Seng Index is actually a top performer right now in a 3-month rolling basis at 21%, followed by the China A50 at 11%. The German DAX is up at 9.9%, whereas the SPX and the Nasdaq 100 is up at 6% and 5% respectively, and the Nikkei 225 is up by 2% according to their rank according to their respective domestic currency. So based on the rolling 3 months performance basis as of now, okay, with the dollar index going sideways. All right, so what we could see over here is that the dollar index sideways, momentum factor at play, micro factor at play is driving the other outperformances of the other major stock indices over the US major stock indices. So this is 3-month rolling performance basis. So if you look at from a longer term, a year-to-date perspective, that means since the start of this year until now, we could see over here is that the top performer is actually the Japan 225, followed by the Hang Seng Index over here, then followed by the China A50 as well, whereas the Nasdaq and the S&P 500 is trailing behind this Nikkei 225, the Hang Seng Index, as well as the China A50. All right. So the Nasdaq 100, yeah, is slightly almost the same as the DAX 30. Okay, the German DAX. All right. So what you could see over here is it seems to us that from a year-to-date basis, and as well as the more shorter time frame, the 3-month basis over here, 3-month rolling basis over here, is that other major stock indices is actually outperforming the major US stock indices, the Nasdaq as well as the S&P 500, all led by this momentum factor, macro factor, and as well as a sideways dollar index. So that is the clear intermarket analysis play that is ongoing in the market right now. Okay, so now with that, right, let us now jump straight into the short-term technical outlook, all right, on the various cross asset classes, starting from the major indices first. All right, so let us start with the short-term technical outlook on the Nikkei 225. All right, so let me expand my screen so that you guys could see. Okay, so on the Nikkei 225, last Friday we were bullish at 38,300, looking for a breakout of this congestion zone, and this congestion zone indeed staged a bullish breakout over here this early today's Asia session, and hitting the second resistance that we highlighted earlier at 39,500 level. So what we could see right now over here, right, so this level has already been taken out. Okay, so taken out. Okay, so right now over here. So right now, potentially it could shape a pullback over here towards 38,900 level, 38,900 level. So this pullback level here will be my pivotal support right now, 38,900. Okay, so let me copy. 39,000, sorry, not 39,000, 38,9330. Okay, 9330. Okay, so this will be the next support level to watch. Okay. Remove this, remove this. Okay, so given today's bullish breakout above its range, so we will still, this short-term range, we will still maintain that short-term bullish bias on the Japan 225. Potentially right now, the RSI is at the starts to actually exit from the overbought level. So potentially there could be a minor pullback. So as long as this minor pullback didn't actually break below this short-term pivotal support level over here, a tightened one at 38,930, we will still maintain this short-term bullish outlook on the Japan 225. First resistance to watch 39,500 for today, followed by 39,810, 39,990, which is the congestion area over here. Okay, the clear congestion area from 4th of April to 12th of April level. Right. However, only an hourly close below 38,930 will invalidate this bullish tone to see another round of choppy corrective movement to retest the next support level at 38,520. Below it exposes 38,300, which is this potentially upward sloping 20-day moving average, also acting as a support level as well at 38,300. Hang Seng. So Hang Seng continued to actually rally last Friday, shaping a series of higher high over here and hit the first resistance level that we highlighted at 19,400 or so, approaching the second resistance at 19,980 on last Thursday, not last Friday. Last Friday we do have the daily doses. Last Thursday. So with that, right, we will actually tighten the key short-term pivotal support for today at 19,300. So as long as 19,300 key short-term pivotal support holds, we will still maintain this short-term bullish bias on the Hang Seng Index, which is the Hong Kong 33. First resistance to watch for today will be at 19,980. Above it exposes 20,380, which is close to the upper limit of this minor ascending channel that I drew from the low of 19th of April, and as well as a Fibo extension level as well at 2,400 level 1.382. Also 2,380 also correspond to this very clear graphical minor swing high area of 28th of July and 31st of July last year. Okay, over here. Okay, only a clear 1 hour close below 19,300 will invalidate this short-term bullish bias to see a minor corrective pullback scenario unfolding, exposing the next near-term support area at 18,965, followed by 18,680 on the Hong Kong 33 index. Okay, German 30. So German 30 on last Thursday it actually came down, kind of having a challenge the short-term pivotal support area at around the 8,700 area. So we have a bit of excess on last Friday swing low, which is at 18,640. So what we could see over here is that the RSI also shaped a bullish reversal as well, right from the oversold region. So no change. I would say that it's more like a whipsaw around the 18,500 short-term pivotal support that we highlighted earlier on last Thursday, having a bit of excess taking into account last Friday swing low 18,640. So as long as 18,640 short-term pivotal support holds, maintain this short-term bullish outlook on the German 30 to actually resume its impulsive up move. First resistance to watch will be the current all-time high at 18,920. Above it exposes the next resistance level at 19,030/19,070, which is a Fibo extension level, cluster level 1.382, taken from the low of 19th of April, and 2.618 taken from the low of 25th of April. Okay, that's give rise to the 19,030/19,070 resistance level after 18,930, which is the current all-time high. Only an hourly close below 18,640 will negate the bullish tone to kickstart another round of minor corrective decline to expose the next near-term support at 18,470, followed by 18,320, which correspond to the upward sloping 20-day moving average. US major indices, US Wall Street 30, like I mentioned, the US Wall Street 30 managed to actually go over the 40,000 level, which is the current all-time high area over here. Okay, so with that, I will actually have a tighten key short-term pivotal support for today using a last Thursday first support level where it actually rebounded and staged that reversal over here. Okay, so this will be my tighten key short-term pivotal support for today on the US Wall Street 30, which is the Dow Jones Industrial Average. So this level will be the 39,770. Okay, so as long as 39,770 holds, okay, we will maintain that short-term bullish outlook on the US Wall Street 30, i.e. Dow Jones Industrial Average, with the next resistance coming in at 40,360/40,430, which actually confluence with a Fibo extension cluster level, 2 times Fibo extension cluster level, 2 times Fibo extension taken from the low of 19th of April, and we in it taken for the 0.618 from the low of 1st of May. Okay, that's give rise to this Fibo extension cluster. As long as 39,770 holds the tighten key short-term pivotal support. Only an hourly close below 39,770 will invalidate this short-term bullish bias for today on the US Wall Street 30 to kickstart another round of minor corrective decline to expose the next support level at 39,560. Okay, 560 followed by 39,260 next. All right, over here. Nasdaq 100. So Nasdaq 100 still trapped below the current all-time high area, but what you see over here, it managed to shape that bullish reversal hammer candlestick as well after testing the first support level that was highlighted on last Friday, okay, before shaping that reversal, that recovery in the later part of the US session. And also the RSI also seems to be on support as well. If you look at the RSI, it managed to bounce off this parallel ascending support that I drew from the low of 1st of May. Okay, and also above the 50 level mark. Okay, indicating to us there's some signs of short-term bullish momentum creeping back into the Nasdaq 100. So with that, right, with this this slew of two positive element, positive hourly RSI and positive bullish hammer candlestick on the hourly chart seen on last Friday, with the positive follow through throughout the later part of the US session on last Friday, I will have a tighter key short-term pivotal support level. Okay, taking into account over here. All right. Okay, let me remove it. Okay. Okay, there'll be 18,430. Okay, so 18,430 will be my Titan key short-term pivotal support level for today, instead of using the previous one at 18,450 because of the two positive elements that I highlighted earlier. Okay, so as long as this Titan key short-term pivotal support holds for today at 18,430, above the current all-time high area at 18,660, may expose us the next intermediate resistance at 18,850, which is the one-time Fibo extension level taken from the low of 2nd of May, followed by 18,990, 19,055 next. Only an hourly close below 18,430 will invalidate this tone to see another round of a minor corrective pullback, a much steeper one, to expose the next near-term support at 18,250. Below it may see the next support level coming in over here at 18,100 level. All right, so that's for the Nasdaq 100. So overall, the current technical configuration still remains more of a short-term bullish bias for the major stock indices, right, that I highlighted earlier. So now let us move on to the FX market, starting from the European currency. So let's start with the euro dollar. So euro dollar going to trade in a sideways range. So on last Friday, we do highlight that as long as last Thursday. As long as 1.09 level holds, potentially we could see another round of a minor corrective pullback towards 1.0825. So I'm still no change. I'm still using this 1.09 level as my short-term pivotal resistance. As long as this level is not surpassed, potentially there could be another round of minor corrective pullback. First support levels to watch will be at 1.0825 / 1.08 level, okay, which is confluencing with the minor descending channel support that I drew from 1st of May. Only an hourly close above 1.090 will invalidate this minor corrective decline scenario to see the continuation of that rebound in the euro dollar to expose the next resistance level at 1.0925 / 1.0940, followed by 1.0960 next. Sterling dollar right now is actually retesting the limit of the short-term pivotal resistance that we highlighted on last Thursday, 1.2685, 1.2610. So as long as this level didn't surpass to the upside, we still maintain that potential short-term bearish bias for a minor corrective pullback. Support level to watch will be at 1.2640 / 1.2610, which is the former minor swing high area of 3rd of May, and also the close to the 50-day moving average. I think as a support right now as well at 1.2610. Only an hourly close above 1.2710 will invalidate this minor corrective pullback scenario to see the continuation of the rebound in the sterling dollar to expose the next resistance at 1.28 figure, followed by 1.2860. Asia Pacific currency. So let us start with the Australia dollar. So the Aussie dollar continue to remain kept below the short-term pivotal resistance, 0.6730, 67.50. So as long as this level didn't surpass the upside, potentially there could be another round of minor corrective pullback to watch this near-term support area coming to as a support at 66.45, 66.20, which is the minor ascending channel support. Also as well, I drew from the low of 19th of April. Only an hourly close above 67.50 will invalidate this short-term this pullback scenario to see the continuation of the rebound towards 67.80, followed by 68.40. All right, so 67.80 is the top of the channel, and 68.40 will be the one-time Fibo extension level of this ongoing bounce taken from the low of 19th of April, as well as this graphical area over here. Okay, this graphical swing high area of 29th of December and 2nd of January last year, early this year. Okay, so that's for the Australia dollar, still holding below that short-term pivotal resistance at 67.30, 67.50. Then what's next on very quickly on spot gold. So spot gold, this is what I call the push up, the bullish acceleration. As you can see, the price action very clearly surpassing the high of the upper limit of this minor descending channel, clearly taking into account of the current geopolitical risk premium that is rising due to the unfortunate helicopter crash that took shape in Iran, which carried the president of Iran and the foreign minister of Iran that is still declared missing at this juncture. So next resistance to watch will be at highlighted on last Thursday again. That's the 2,450 right now. So I put in another additional level, which is at 2,480 / 2,480, 2,490, which is a Fibo cluster level over here. Okay, Fibo extension cluster level, and as well as there could be a minor pullback given the RSI right now is at the extreme overbought level, but there is no clear signs of a bearish divergence, indicating to us that momentum is still strong. So a potential minor pullback first support level to watch will be at 2,413, but I don't want to use this 2,413 as my Titan key short-term pivotal support. I'll rather use last Thursday minor swing high level at 2,395 level. All right, so 2,395 level, if we do the Fibo extension of this current push up from last Thursday, is close to the golden ratio as well, or 61.8%. All right, so as long as the pullback didn't surpass below 2,395 and also close to that psychological level of 2,400, we will still maintain that short-term bullish bias on spot gold XAU / USD. First resistance to watch 2,450, above it exposes 2,480, 2,490. Right now, only hourly close below 2,395 will negate the bullish tone to see another round of minor corrective pullback to expose 2375 next level of support slash 2355, followed by 2337. If 2355 cannot hold, that also correspond to the 20-day moving average acting as a support level as well. So net overall still maintain that short-term bullish bias on spot gold with a tightened key short-term pivotal support for today at 2395 level. So like I explained earlier on, rising geopolitical risk premium that triggered due to this due to the event in the Middle East is also seeing West Texas oil on a firmer footing as well. All right, so what we could see is we see 3 consecutive days of rising prices after price retested that 78.40 medium-term pivotal support level. And what you could see over here on a weekly basis, okay, you go to the weekly chart, the price action also shaped a bullish morning star, okay, a bullish reversal morning star, taking into account of these 3 candlestick, a long black candlestick, kind of a doji, followed by a positive candle, all right into the body of the black candlestick, the black marble zoo. So this is what I call a 3 candle morning star bullish reversal candlestick formation. And where it occur right at the lower boundary of this medium term ascending channel that I drew from 13th of December last year, which is the 78.40 medium term pivotal support level as well. Okay, so with this weekly bullish reversal candlestick that has taken form on West Texas crude oil, so for today I'll be much more confident to flip to a bullish bias, all right, rather than a neutrality stance. But I will not, the first support level to watch will be at 79.25. Okay, it will be a range of 79.25 followed by this 78.40 level, but I don't want to put it so tight, just in case of any whipsaw again on an intraday basis. So I'll use 77.20 as my short-term pivotal support level, just in case of any whipsaw. So this is the lower swing low of 8th of May and the swing low of 15th of May, conferencing at 77.20. So as long as any whipsaw didn't break below 77.20, we will still maintain that. If we flip to a short-term bullish bias above 80.30, which is the 200-day moving average, and as well as the minor swing high area of 2nd of May and 10th of May that is acting as a resistance so far, a clear break above this level, that means i.e. an hourly close above this level, will expose the next near-term resistance zone of 81.70 slash 82.60, which is also confluence with the 50-day moving average acting as a support level, as a resistance level right now. Only hourly close below 77.20 will invalidate this bullish tone to see another round of decline extended to 75.50, then below it exposes 73.60 next on the West Texas crude oil. All right, so that's pretty much sum up for today's short-term technical outlook across the broad-based cross asset classes. So before we go today, let's have a quick look at the calendar. What are the key events to look out for? Right, so let's take a look at today's calendar. Yeah, so today's calendar. So today's calendar over here, okay, just a while ago, the China market, the PBOC, the China Central Bank, make no changes to its another key benchmark interest rate, which is the loan prime rate, the 1-year loan prime rate, and the loan prime rate for the 5-year. So these prime rates are actually benchmark used to price consumer, business, and businesses loan as well as housing loan. So no aggressive easing from the PBOC, still maintaining at that 3.45% and 3.95% respectively. So throughout the European session will be rather quiet today. And what do we have is that over at 8:45 p.m. Singapore time, before the start of the US session, we do have a Fed Bostic speaking, Federal Reserve official Bostic speaking at 8:45 p.m. And we no key economic data for today, but in fact it's a slew of Federal Reserve officials speaking. At 9 p.m. we have Fed Bar, 9 p.m. Fed Wheeler, and lastly 10:30 p.m. Fed Jefferson. And early 7 a.m. Singapore time, we do have Fed Bostic speaking again. All right. And also before the start of tomorrow, Asia daily dose for tomorrow, we do have 2 key data and event that for Australia. 8:30 a.m. The Westpac consumer confidence data, and as well as 9:30 a.m. the release of the previous latest RBA meeting minutes. Right, so that pretty much sum up for today's daily dose of market insights. Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.